In the last 4 weeks, we've been looking at wealth from 4 different angles. First, the industries where money is made the fastest. Second, the tests that every millionaire has to pass before they break through. Third, the archetypes of people who actually do it. And finally, the places that make everything possible. So today, we're stitching it all together. You can think of this as a sort of a roadmap. By the end, you'll see exactly how the self-made millionaires stack the odds in their favor. So, with that being said, let's dive in. In 2024 alone, almost 684,000 people became millionaires. Just imagine about 2,000 people waiting in line to join the millionaire ranks every single day. The United States leads the charge here, creating more than 379,000 millionaires in a single year. That's more than half the global total. But what's interesting is that emerging markets are now producing millionaires at a staggering pace. In India, in just 1 year, around 40,000 people became millionaires. That's 1 every 15 minutes. Entire neighborhoods are flipping from middle class to millionaire status in less than a decade. China continues to produce more millionaires than any other country outside the US. But, it's not universal. Some countries are actually shrinking their millionaire populations. The UK and Japan both lost millionaires last year as wealthy individuals packed up and left, or simply watched their fortunes shrink as their local currencies weakened against the dollar. So, while the overall pie of wealth is expanding, the slices aren't exactly equal here. Only a few industries are really doing the heavy lifting, and that's where the real story begins. Which industries are doing this, and why do they keep producing millionaires decade after decade? Let's take them all one by one. But before we do that, just a quick note from us, okay? Because we've designed a tool that can really help you spot these trends and act on them in ways that will actually benefit you. Inside the Alux app, there's daily coaching sessions designed to help you level up across all areas of your life, especially in your finances. We hire industry experts to walk you through all the key lessons they learned to achieve their great success. And with help from them and us, you'll be crushing one goal after another. And even better, if you download the app and scan this QR code on screen, you'll get 25% off your annual membership. I'll see you on the inside, but in the meantime, let's get back to discussing why certain industries keep producing millionaires, starting off with real estate. Now, real estate is one of the most reliable millionaire factories in the world, right? You probably know this. According to the UBS Global Wealth Report 2025, property remains the largest single asset class for high net worth individuals, with nearly 27% of their wealth tied up in real estate. But what's most important here is how ordinary people cross the 7-figure line. In the US, NAR data shows that successful real estate agents and small brokers regularly hit millionaire status through commissions. In hotspots like Dubai and Manila, property prices surged 44% and 21% between 2019 and 2023, minting tens of thousands of new local millionaires. The mechanism is pretty straightforward: leverage. With a down payment, you control an asset far bigger than your cash investment. If that property appreciates, the equity you build can snowball quickly. A single rental portfolio or a few flipped homes can push a disciplined investor past millionaire status in less than a decade. In India, Knight Frank reported that nearly 1 in 5 new millionaires cited real estate as their primary wealth source in the last 5 years. In fast-growing economies, building even modest apartment blocks or commercial spaces can turn into life-changing wealth. So while real estate doesn't mint unicorn billionaires overnight, it steadily turns hundreds of thousands of people into millionaires every year. It's accessible, okay? It's tangible, and in the right market, it's still one of the most powerful wealth escalators on Earth. Then there's healthcare and medical services. Because according to Oxfam's Pandemic Wealth Report, more than 40 new healthcare billionaires were created during COVID. But far more interesting is the wave of new millionaires in pharmaceuticals, clinics, and medtech. In India, generics are a massive millionaire machine. The country supplies over 20% of the world's generic drugs, and mid-sized manufacturers and distributors built fortunes during the pandemic boom. A Knight Frank survey found that a growing share of India's new millionaires cite healthcare and pharma as their primary source of wealth. In the US, private equity has been rolling up dental practices and outpatient clinics, turning ordinary doctors into seven-figure business owners once their practices sell. Medtech companies exploded, minting waves of millionaire employees through stock options as share prices soared. Even suppliers in this ecosystem, the companies making parts for scanners or pumps, quietly minted millionaires, okay? What makes healthcare pretty unique is demand. It doesn't collapse with market cycles. People will always need medicine, tests, treatments, and that stability makes it less volatile than tech, but incredibly steady as a millionaire factory. From generic drugs in India to clinic roll-ups in the US, healthcare is quietly producing a new millionaire class every single year. But what about fashion and retail? Because interestingly enough, fashion and retail turned out to be one of the most consistent sources of new millionaires, especially in the last 5 years. Consumer demand is endless, and the internet leveled the playing field. According to Shopify's 2024 Impact Report, over 5 million merchants run stores on its platform, and thousands of them have crossed the seven-figure mark in sales. Amazon has a pretty similar story. Marketplace Pulse estimates that in the US alone, more than 60,000 Amazon sellers generate over $1 million in annual revenue. But here's the thing with retail, okay? The vast majority of e-commerce, dropshipping, and direct-to-consumer brands fail. But because the barrier of entry is decently low and a huge amount of people are doing it, even a small percentage of success equals tens of thousands of new millionaires. It's not that e-commerce is such an amazing business strategy, but more like the sheer number of attempts which creates a constant stream of new millionaires. With the right margins, some brands do manage to be worth $5 to $20 million in revenue. All right, switching gears to talk about manufacturing and supply chains for a moment, I've got one thing that might just blow your mind. Over the last decade, manufacturing created more new billionaires than any other industry. Packaging companies supplying Amazon sellers, furniture makers selling IKEA, textile producers feeding Shein. All of these supply chain players have crossed the seven-figure threshold simply by owning a piece of the production puzzle. Margins in manufacturing aren't glamorous or anything, but once you supply a product at volume, profits will snowball fast. Contract manufacturers, niche suppliers, and industrial middlemen are often the ones getting rich while staying invisible. In China, the rise of EVs created a wave of millionaires far beyond Tesla. The companies making batteries, wiring, and components built fortunes as demand surged. In Germany, there's actually a word for this, Mittelstand, and it refers to small to medium, usually family-owned companies that pretty much sit at the core of their economy. They dominate niche markets by owning obscure but essential products like precision screws or industrial pumps. It doesn't exactly sound very sexy at all, but hey, all right, at the end of the day, the numbers are there. If you think about it, it all goes all the way back to the gold rush. During the California gold rush, the people who got rich were typically not the people prospecting for gold. It was the merchants and suppliers, Levi Strauss selling jeans, Samuel Brannan selling picks and shovels, boarding house owners charging inflated rents. The infrastructure around the gold created a more reliable fortune than the gold itself. The modern millionaire machine is often the people selling the picks and shovels of today's industries. Next up, we're looking at finance and investments, okay? If there's one industry that reliably mints new millionaires every single year, it's finance, right? Not just the hedge fund billionaires you read about, no, but the thousands of bankers, traders, private equity partners, and venture capitalists who cross the seven-figure threshold thanks to bonuses, carried interest, and equity stakes. At firms like Goldman Sachs, Blackstone, or KKR, senior partners and even mid-level executives routinely make millions in annual pay and profit sharing. Becoming a millionaire here is expected after a decade or two at the top. When you're managing billions, a small cut turns careers into fortunes. The problem with finance, though, is it isn't accessible to everyone. You can't just stroll into Goldman Sachs in a hoodie and demand that they let you manage a billion-dollar fund. That only works in Silicon Valley, okay? But this doesn't change the fact that for those who get it, the odds of hitting millionaire status are higher than almost anywhere else. And finally, we gotta talk about tech and startups. Yeah, we know. Who would have thought, right? If there's one industry that completely dominates the creation of new millionaires, it is technology, my friend. Not only does it produce the most billionaires, but it's also the biggest engine for first-generation millionaires, meaning ordinary people crossing 7 figures for the first time. According to UBS and Forbes, tech accounts for over 20% of the world's billionaires, but more importantly, it has created tens of thousands of new millionaires through IPOs, acquisitions, and stock options in just the last decade. Airbnb's IPO in 2020 instantly turned hundreds of employees into millionaires, some with only a few years at the company. Stripe, Canva, and UiPath all created similar waves of millionaire employees and early investors. And more recently, the AI boom has done the same. NVIDIA's rise enriched both Jensen Huang and thousands of engineers, managers, and early shareholders crossed into millionaire territory as the stock soared over 200% in 18 months. Stock options and equity compensation mean that even non-founders, from engineers to product managers, get pulled into millionaire status when the company scales. What makes tech unique is speed and scalability. A direct-to-consumer brand might take a decade to hit $100 million in revenue. A successful app can do it in 2 years. That speed compresses the millionaire timeline, and it's not unusual for someone in their early 30s to become a millionaire in tech. And that's something almost unheard of in any other industry, which is why tech will always sit at number 1. Now, my friend, have you noticed what all of these industries have in common? Well, you see, when you take a closer look, the pattern becomes kind of impossible to ignore. Millionaires don't pop up randomly all over the place. No, they cluster in places where 3 very distinct and important things happen all at the same time. The first is scale, the ability to reach millions of people, not just dozens of them. A Shopify store that cracks Amazon's ecosystem, a tech platform serving global users, a factory supplying parts worldwide. All of these scale beyond what one person could ever sell on their own. Next is leverage, meaning you're using systems, not just your own labor. In real estate, it's mortgages. In finance, it's other people's money. In tech, it's code and servers. In manufacturing, it's machines and supply chains. Leverage multiplies output without multiplying effort. And the last thing you need is growth, meaning you're riding a wave that's bigger than yourself. EV adoption, AI, aging populations, luxury spending in emerging markets. If you're an industry where demand is surging, it lifts you along with it, okay? That's why millionaires keep coming from the same industries decade after decade. They're the ones sitting at the intersection of these 3 forces. So, the real takeaway isn't which specific company or product to chase. It is to position yourself inside the right system. Because if the system has scale, leverage, and growth, then even at a small level, your odds of crossing that 7-figure line go up dramatically. Millionaires don't happen by accident, okay? They happen by design. And that design is built around 3 specific tests. Every person who makes it has to pass them, so let's break them down together, shall we? All right, so the first test that every millionaire must pass is the scale test. Now, most people think scale just means doing more products, more staff, more sales. But if you grow like that, your costs rise just as fast as your income, and you usually collapse under your own weight. This is where the saying, more money, more problems comes from, okay? In business terms, it's called growing broke. Your business is growing on paper, but your costs are rising at the same rate. So you're just working harder for the exact same profit. That's why so many businesses fail when they expand too quickly. They confuse getting bigger with scaling. True scale is about doing more with less. It means finding ways to grow your output without your costs growing at the same pace. And that is a whole lot harder than it sounds. That's why entire job titles like growth hackers exist. Their whole purpose is to figure out how to get 10 times the results without 10 times the spending. And they're paid a fortune because solving this test is incredibly hard. The principle is simple though. The bigger you get, the cheaper everything becomes. Economists call this economies of scale, and it's one of the most powerful forces in wealth creation. Let's just look at some numbers here. A small clothing brand might pay $7 to produce a shirt. At that level, they're just another boutique scraping by. But when you manufacture tens of thousands of shirts at once, your cost per unit falls to around $3. At hundreds of thousands, it drops again. At millions, factories retool production lines just for you, and suddenly you're paying closer to $1.50 a shirt. And the efficiency, it doesn't stop there. Instead of making t-shirts in 5 different sizes, fast fashion brands often stick to just 2 or 3 of the most common ones. And that decision alone saves them millions in fabric, patterns, logistics, and unsold stock. It's also why nothing fits you unless you're tall and skinny. A 2019 investigation into Zara's supply chain found that the factory production cost of a hoodie was just €2.08, while Zara retailed it for nearly €30 in Europe. That's a 15x markup, powered entirely by scale and efficiency. At volume, the economics flip so hard in your favor that smaller competitors they don't stand a chance. And that's why competing with Zara or Shein is basically impossible unless you own the factory. Their scale gives them cost structures that no small brand could ever replicate. Now, when you're already big, lowering costs is relatively easy. Big companies can buy scale by placing giant orders and forcing suppliers to cut costs. But when you're small, you don't have that advantage, right? And that is when creativity decides if you make it or not. Instead of hiring 10 people, you find a way to automate repetitive work so that one person does the job of 5. Instead of selling door-to-door, you run a single ad campaign that reaches thousands at once. Instead of offering endless variations, you strip your product down to one version that can be produced endlessly without waste. There really isn't a good answer for this test. It's a matter of building the right systems. Passing the scale test at a small size proves that you know how to grow output without letting costs eat you alive. The second test that every millionaire must pass is the leverage test. At its core, leverage is just a math problem, really. It's about balancing 3 things: outcome, probability, and cash flow. So outcome is how big the upside or downside can be. Probability is the chance it actually happens, and cash flow is whether you can survive long enough if it doesn't pay off right away. And the better you are at running this math, the more leverage you can afford to take on and the faster you can grow. If scale is about efficiency and making things cheaper as you grow, leverage is about acceleration. It's what turns a small operation into a business that grows faster than you do. Now, there are 4 main types of leverage, and every millionaire has solved at least one of them. The first is financial leverage, which, it's the most obvious. You borrow money to expand operations. Imagine that you're a founder who takes out a $100,000 loan at 5% interest to launch a new product. The loan costs you $5,000 a year in interest plus repayment. If the product brings in $120,000 after cost, you've cleared $20,000 in profit even after paying that loan back. That's a win. But if sales flop and you only bring in $70,000, you still owe the bank $100,000 plus interest. Suddenly, you're in the red. So, can your business survive the downside scenario long enough to reach the upside? If yes, then financial leverage works in your favor. Secondly, we've got people leverage, when you hire employees or contractors to multiply your time. So let's say you hire a salesperson at $4,000 a month. If they consistently close $12,000 in sales, they pay for themselves 3 times over. That 3x number is not random, okay? It's a rule of thumb in business. For a hire to make sense, they need to generate at least 3 times their salary, and that is because at 1x, they only cover their own costs with nothing left for rent, tools, or marketing. At 2x, they cover their own salary plus the day-to-day cost, which means a little bit of profit. At 3x, you're finally in a sweet spot where salary and expenses are covered and there's profit left over. So the people leverage test is finding roles where $1 of payroll reliably turns into $3 of value. All right, moving on, the third main kind of leverage is technology. Now, the test here is how you handle the massive upfront cost, because any kind of tech needs a decent chunk of money to be developed, plus the maintenance costs to keep it running. We know this firsthand, okay? Building a great app is not exactly cheap. Let's say you spend $50,000 building a software tool. If you can attract 1,000 users paying $10 a month, that's $10,000 in monthly revenue. You break even in 5 months, and after that, it's almost pure profit. But, if only 50 people sign up, you're making $500 a month, and it'll take over 8 years just to break even. If it works, you win big. But if it fails, you are 100% done, my friend. And lastly, we've got media leverage. Now, the test here is finding a way to cut through the noise. This is where companies hire kids to make brand-related memes on Twitter and call it a day. Yeah, we're still calling it Twitter, okay? Let's be real. Every self-made millionaire has cracked at least one of these leverage tests. Most have mastered more than one. Passing the leverage test isn't optional because it marks the moment you stop running a job and start running a business. You've probably seen people working non-stop on their business, not because they want to, because they have to. They are employees at their own company because, they have no leverage. All right, now moving on, we gotta talk about the third test every millionaire faces, and it is the test of luck. Now, this is one that nobody likes to admit because people want to believe success is all about skill, hustle, and strategy. But look, okay, there's always an element of timing and positioning that you simply can't control. Luck here means being in the right place at the right time in a market that's about to grow. And you don't get to decide when that growth happens, but you do get to decide the arena you step into and when you make your move. Right now, AI is exploding, okay? The industry was worth around $200 billion in 2023, and by 2030, it's projected to reach nearly $1.8 trillion. That's an annual growth rate of almost 40%. Salaries for AI engineers are climbing, stock options are turning into fortunes, and companies like NVIDIA have tripled their value in less than 2 years. Like it or not, okay, your next fridge might applaud your choice of breakfast. That is how deep AI is embedding itself into everyday life. And if you're positioned inside that wave as an employee, an investor, a supplier, even just a freelancer who learns how to use these tools, the tide itself is pushing you forward. Now, back in the 1980s, AI had its first big hype cycle. Money poured into research, expectations soared. But back then, reality just didn't deliver fast enough. Governments pulled funding, corporations abandoned projects, and what is now called the AI winter froze the industry for years. But now it's the same field, the same skills, just a different decade, and the outcome was the complete opposite, right? Right place, wrong time. You see the same thing in other industries too, like solar energy in the 1980s, VR in 2016. That's the essence of the test of luck. The same effort, the same talent, even the same product can lead to a fortune or a failure depending on when the world is ready. So, how do you tilt the odds here? Well, the first way is by choosing industries where long-term demand is undeniable. We ranked these industries in the previous video, which you can check out in the description. Aging populations, for instance, is a big one, okay? Every country on Earth is getting older. That means more healthcare, more medicine, more caregivers needed. The same goes for the energy transition. Fossil fuels are being replaced by renewables whether we like it or not. And once a technology like AI proves itself, adoption only accelerates. People don't go back to pre-AI workflows. The second way is diversification. You don't have to get every call right, okay? Some fail, but 1 or 2 will ride the wave, and that is enough to cross the 7-figure line. And the third is timing your entry. Too late and you're fighting out incumbents who already dominate the market. Too early and you run out of resources before the market even matures. The sweet spot is when growth is accelerating, not pure hype, not total saturation, but the inflection point in between. This is why millionaires often look lucky. From the outside, it seems like they were just in the right place at the right time. And, in a way, they were. But what most people don't see is that they put themselves in situations where growth was likely. They took multiple shots, and they stayed ready when the timing lined up. Passing the test of luck means your effort compounds because the world itself is pushing you forward. Failing means you can work just as hard as somebody else, maybe even harder, but your results collapse because the timing wasn't right. Scale makes your product efficient. Leverage accelerates your business. And luck, which is timing and positioning, ensures the entire path you're on is actually growing on its own. Put all three together, and they multiply. That is why these 3 tests explain almost every self-made millionaire story. So, if these are the 3 tests every millionaire must pass, which one do you think you would struggle with the most? Let us know in the comments. We're curious to know. All right, so these are the 3 tests every millionaire has to pass. You've seen the rules of the game. Next up, it's time to meet the players. Because millionaires usually fall into just a few clear archetypes. From the builder to the operator to the investor, each one of them takes on a different path through these same tests. So let's look at who they are and figure out which one you might be. About 70% of millionaires and billionaires are self-made, and when you zoom out, every single one of them fits one of these 5 archetypes. The entrepreneur builds systems. The investor multiplies capital. The specialist monetizes rare skills. The operator runs proven models. And the hybrid bridges career income into assets. So, which one are you? Let's break them all down. All right, so the first archetype we're talking about today is the entrepreneur. Entrepreneurs are the builders and the breakers. If you're the kind of person who looks at the world and sees flaws everywhere, this is your path. You itch to fix things. Long line at the store, you're already imagining an app to solve it. A clunky product, you're sketching out how to redesign it. While most people complain, you ask, what if there was a better way? You're restless. When a system works, you get bored. You crave the next challenge. That's why entrepreneurs often launch multiple businesses or constantly reinvent their companies. The reward is proving to yourself that you can beat the odds again and again. You're wired differently around risk. The average person runs from uncertainty, but you lean into it. You'll spend your own savings to test an idea, hire someone before you feel ready, or jump into a new industry because you see the potential. You call it calculated risk. You know that waiting until everything feels safe usually means the opportunity is already gone. If you've ever thought, if I was in charge, I'd do this so much better, or you've left a job because the system was too slow, too dumb, or too political, chances are you're an entrepreneur at heart. But how did they pass the millionaire test? Well, the scale test, first of all. This is where entrepreneurs shine brightest. They're obsessed with turning one-off wins into repeatable machines. A single restaurant sells pizza. A chain of restaurants builds centralized supply, lowers cost per unit, and doubles margins. Software takes it even further. One version costs millions to build, but selling it to the next customer costs almost nothing. Entrepreneurs are masters of building systems where growth makes the business stronger, not weaker. They also have to pass the leverage test. Now, entrepreneurs thrive on leverage. They raise capital, use loans, negotiate supplier credit, and hire teams long before they could do it alone. They're also heavy users of technology leverage. Software, automation, and digital marketing let them reach millions at near zero marginal cost. Passing this test, it's all about balance, okay? Too little leverage and growth stalls. Too much, and one mistake could kill the business. The best entrepreneurs walk this line carefully. Then there's the luck or growth test. Timing is critical, okay? Being too early means educating a market that doesn't care yet. Being too late means facing entrenched competitors. Entrepreneurs who thrive, they catch waves at just the right moment. E-commerce in the 2000s, social media in the 2010s, AI in the 2020s. The smartest tilt the odds by chasing industries already showing explosive demand. The lesson here is that entrepreneurs pass all three tests at once: scale, leverage, and timing. Most, well, they fail. But the ones who succeed build the most powerful wealth machines in history. On to archetype 2, the investor. So, investors are multipliers, okay? If you're the type who would rather analyze numbers than pitch a product, this is you, my friend. You're not interested in building from scratch, but you'd rather take capital and make it grow. You're patient in the way that most people aren't. While everyone else wants quick wins, you're comfortable with letting time do the work. You know that €10,000 growing at 8% isn't going to change your life this year. But over decades, it is life-changing. You think in compounding curves, not instant hits. You're disciplined. Investors don't chase hype or gamble on the latest trend. No, you care less about excitement and more about survival. To you, the first rule is simple, okay? Don't lose money. Growth comes second. That's what separates investors from speculators. If you've ever looked at a paycheck and thought, how do I make this money work for me instead of spending it? Well, you're already thinking like an investor. So how these folks pass the Millionaire tests? Well, when it comes to the scale test, capital scales by itself. €10,000 at 8% is €800. €10 million at 8% is 800,000. The process is the same, but the outcome multiplies with the base. Investors know this, so they can protect their capital and let compounding do its work. The bigger the base, the faster the wealth accelerates. In terms of the leverage test, investors master financial leverage. Real estate investors use mortgages to buy properties larger than their savings. Private equity firms buy companies using borrowed money. Even small investors use debt carefully to amplify returns. The key is matching debt with stable cash flow. And when it comes to the luck or growth test, investors live and die by timing, okay? Buy at the wrong time and compounding barely works. Buy at the right time and decades of growth will follow. US stocks from 1980 to 2020 produced fortunes, but Japanese stocks over that same period stagnated hard. Smart investors diversify across markets and sectors to tilt the odds in their favor, but luck always does play a role. The lesson here, investors, they don't get rich fast. They get rich steadily, then suddenly. Protect capital, reinvest it, and let time do the compounding. On to archetype 3, the specialist. Now, specialists are masters of one thing. If you've ever been the go-to person in your field, the surgeon who can do what others can't, the lawyer who wins the impossible case, the engineer who solves problems nobody else can, well, you are a specialist, okay? Your edge is scarcity. There are countless generalists, but very few people who can do what you do at the level you can do it at. That scarcity makes your time valuable. The world pays a premium for rare expertise. You are obsessed with mastery. Where others skim the surface, you dive deep, okay? That focus is what puts you above the crowd. The challenge is that your wealth depends on you. If you stop, the income stops. Specialists earn some of the highest salaries, but unless they convert that income into assets, well, they hit a ceiling. If you've ever been told, you're so good at this, you should charge more, well, you are a specialist. But how do they pass the Millionaire tests? Well, when it comes to the scale test, specialists, they often fail here. Their income is capped by time. A surgeon can't operate on thousands of patients. A lawyer can't handle unlimited cases. To pass this test, specialists have to productize themselves. Books, courses, firms, or licensing. That way their expertise scales beyond their hours. In terms of the leverage test, specialists leverage credibility. Their name becomes a magnet for clients, deals, or endorsements. Lawyers become partners who bring in business. Doctors open up clinics and hire juniors. Athletes sign brand deals or negotiate equity stakes. The reputation they build becomes a tool for multiplying income streams. In terms of the luck or growth test, Well, timing multiplies outcomes. Being a software engineer in 2003 was steady. Being one in 2023 with AI exploding can make you rich. The same skill in a different decade creates radically different outcomes. Specialists who choose the right industries, well, they ride growth waves they didn't create themselves. The lesson here, specialists can earn more than anyone else, but earning isn't wealth. The ones who win are those who turn today's high income into tomorrow's assets. All right, on to archetype 4, the operator. So, operators are executors at heart, okay? If you're the type who loves taking proven systems and running with them with relentless discipline, this is your lane. You don't need to invent something new. No, you'd rather take something that works and scale it with precision. You thrive on structure, don't you? Where entrepreneurs chase chaos, you crave order. You're the one who makes sure the trucks leave on time, the staff shows up, the shelves stay stocked, and the invoices get paid. You live in details that most people ignore, and that is why you win. Your edge is replication. Once you find a formula that works, you can copy it again and again and again. 1 restaurant location pays the bills. 10 makes you wealthy. 20 makes you rich. Operators know how to build quiet empires 1 unit at a time. If you've ever looked at a franchise or a local business and thought, if I owned this place, I'd run it better than the guy who does, you are probably an operator. So, how do operators pass the Millionaire tests? Well, in terms of the scale test, operators pass by duplication. Perfect 1 unit, a store, a contract, a truck route, then roll it out again and again. Each new unit lowers average costs and widens the margin. Their growth doesn't come from invention, but repetition. In the leverage test, operators lean on debt and teams. Banks love them because their businesses have collateral and steady cash flow. They finance trucks, warehouses, or stores with loans, and then train managers to keep the system running without them. People and capital do both of the heavy lifting. In terms of the growth or luck test, operators don't need world-changing trends, okay? They just need a steady local demand. A trucking company grows when e-commerce grows. A contractor thrives when housing expands. Their luck is choosing industries that never go out of style. Food, housing, logistics, repairs, that kind of thing. The lesson here, operators prove that boring businesses often make the best fortunes. Replication, order, and discipline build wealth slowly but securely. Then finally, there is archetype 5, the hybrid. So, hybrids are bridge builders, okay? That's what they're good at. If you have a solid career and good income, but you're constantly thinking about how to turn that paycheck into something bigger, this is your path. You value stability. You don't want to risk everything on a startup, but you also don't want to rely on a salary for 40 years. You prefer a middle ground, steady income for safety plus assets on the side for freedom. Your edge is discipline. While others inflate their lifestyle with every raise, you funnel extra money into real estate, stocks, or side businesses. You know that over time, these assets will pay you more than your job. Hybrids, they play the long game, okay? They don't need to be the fastest. They just need to be consistent. If you've ever thought, my income is pretty good, but it should be working harder for me, then you are a hybrid. So, how do hybrids pass these Millionaire tests? Well, the scale test, salaries don't scale very much, do they? But assets, they do. At first, saving €20,000 a year feels kinda slow, but once investments compound, the portfolio can earn more in a year than you save. The tipping point comes when assets grow faster than income. That is where wealth snowballs. In terms of the leverage test, hybrids use leverage carefully. Mortgages on rental properties, stock options at work, small business investments, all underpinned by steady job income. Their career acts as insurance so they can take some risks without blowing things up. In terms of the luck or growth test, well, hybrids benefit most from being in the right industries. A banker in private equity, a tech worker with stock, a doctor buying property in a booming city. The alignment of career and investments multiplies outcomes. Timing their industry choice often matters just as much as their discipline. The lesson here is that hybrids show you don't need extreme risk to build wealth. By converting income into assets year after year, they quietly cross into the millionaire status while others spend their raises. If you recognize yourself in one of these, you already know your path. But here's the twist, okay? Where you play the game matters just as much as how you play it. An operator in a booming city has more chances than one in a shrinking town. A specialist in the right industry earns 10 times more than the same skill in the wrong one. Even entrepreneurs and investors perform differently depending on where they start. So, if you want to tilt the odds in your favor, the next question is simple. Where are the places where it's easiest to get rich? We'll start off today's discussion by looking at the macro map, okay? Because strong economies mean strong chances. Here's the blunt truth, okay? Where you live massively affects your odds of getting rich. Not because you're smarter or lazier than anybody else, but because the game board itself is tilted. Imagine starting the same business in two places, okay? Silicon Valley and Caracas. In California, you've got venture capital on speed dial, reliable internet, and customers who think nothing of paying $10 for an app subscription. In Venezuela, on the other hand, you're fighting inflation that can hit triple digits, power blackouts, and currency that's losing value faster than you can earn it. The same idea, two radically different outcomes. And that is why millionaires don't just pop up randomly all around the world. They always cluster in strong economies. And I mean, look, here's a number that hits hard, okay? The US alone has around 23 million millionaires. That's more than Germany, the UK, Japan, and France combined. Meanwhile, entire regions like Latin America and Africa together have fewer millionaires than just California alone. The difference isn't in ambition, okay? It is the environment. So what exactly makes a strong economy better for building wealth? Well, there's three things. First of all, infrastructure. Wealth needs plumbing, electricity, internet, logistics, supply chain, and a bunch of other things you usually take for granted. In Germany, a factory order gets shipped overnight with tracking down to the minute. In Sudan, that same order might sit in a port for months. Think of infrastructure as the soil. You can plant the best seed, but if the ground is dry and rocky, nothing grows. In rich economies, though, that soil is fertile. Second of all is markets, okay? Because you don't get rich selling to people who can barely cover rent. Disposable income is the oxygen of a business, and strong economies, they've got plenty of it. That's why Starbucks can charge $7 for a latte in San Francisco, while many people survive on less than $2 a day in Bangladesh. In fact, according to the World Bank, over 80% of global consumer spending comes from just 20 countries. If you're selling to broke customers, scaling is impossible. And thirdly, there's capital, okay? Because even the best ideas will die without funding. Strong economies have deep capital markets, or in other words, there are banks willing to lend money, venture funds willing to invest, and stock markets that provide exits. In 2024, U.S. venture capital funding topped $250 billion. Compare that to entire regions where startups raised less than a single Silicon Valley round. That is why unicorns are usually born in California, not in rural Eastern Europe. The same brains, same ambitions, but access to fuel makes all the difference. And if you want the biggest case study of them all, we can look at the Korean Peninsula real quick, okay? Same people, same culture, same resources, until the 1950s. South Korea embraced global trade, capital markets, and innovation. Today it's home to Samsung, Hyundai, and why not K-pop, which we may or may not be big fans of. North Korea, on the other hand, they chose isolation. Today, it can't keep the lights on. That is how much the system matters. But it's not just extremes, okay? Places like Mexico or Poland both have stable governments, a growing middle class, and decent infrastructure. You can build a successful company there, but compared to the US or Germany, well, the ceiling is kinda low because there is simply less disposable income and a slower infrastructure. It's not impossible, it's just a bit harder. So, here's the rule, okay? The stronger the economy, the easier your climb. In weak economies, most of your energy goes into fighting the system, inflation, corruption, unstable rules. In strong economies, the system actually carries you upward. That's why millionaires multiply in places like the US, Germany, and Singapore, and struggle to emerge in places where just surviving is the challenge. And that's why next we're looking at the micro map, okay? Because here is a secret the rich understand. Wealth does not spread evenly across a country, it always concentrates in various cities. Just think about it, okay? The US is the richest country in the world, but you are not becoming a millionaire or a billionaire in rural Alabama. You go to New York, Silicon Valley, Los Angeles, that is where the money pools. And this isn't just in America. In China, it's Beijing, Shanghai, and Shenzhen. In the UK, it's London. In the Middle East, it is Dubai. Cities act like magnets. They pull in capital, talent, and opportunity, and then recycle them into even more wealth. Here's the shocking stat, though. More than half of the world's billionaires live in just 10 cities. 10 out of thousands. That is how concentrated wealth really is. And here's why cities beat countries. First of all, ecosystems. Wealth builds faster when everything you need is close by. Investors, skilled workers, legal services, suppliers, all clustered in one place. That's why startups don't just come out of anywhere. They come out of Silicon Valley, where the entire system is designed to support them. Secondly, there's density, okay? Cities compress time. In Manhattan, you can meet 3 investors, 2 clients, and a lawyer all before lunch. In a small town, those meetings might take months, or never even happen at all. Thirdly, culture. Cities breed ambition, okay? They normalize high income and risk-taking. If your neighbor is launching a startup or running a hedge fund, suddenly it doesn't seem crazy that you could too. Compare that with a small town, where success might mean owning the local car dealership. Culture sets your ceiling. Take Detroit versus Silicon Valley. Both are in the US. Same laws, same taxes, same currency, yet one collapsed into decline while the other minted trillion-dollar companies. Or look at China. Inland cities lag far behind coastal hubs. Build in Shanghai and you've got capital, shipping routes, and government support. But build in a remote province and you're locked out of networks that make billionaires. Here's something that most people don't realize, okay? Cities are brands. Just like Apple or Nike, they're in a constant battle to attract talent and money. New York sells itself as the finance capital of the world. Los Angeles brands itself as the global entertainment hub. Dubai markets tax freedom and luxury living. Singapore pushes its efficiency and safety. Cities actively compete with each other. London offers incentives to hedge funds. Miami lures tech founders with zero state tax. Even smaller hubs like Lisbon and Tallinn run marketing campaigns targeting digital nomads. Once a city locks in an industry, it compounds. Hollywood became the film capital because early studios set up shop there, and now it's almost impossible to dethrone. Silicon Valley locked in venture capital, talent, and Stanford University. Shenzhen became the global factory floor thanks to manufacturing clusters. This is why you can't separate wealth from location. So here's the takeaway here, okay? Countries give you the baseline, but cities decide your trajectory. That's why millionaires move. They're chasing ecosystems that multiply their wealth-building potential. And even inside the best cities, the rules are not equal. How much you get to keep, how fast you can scale, and whether society helps or punishes you depends on the legal and cultural environment. Which brings us to the next layer: taxes, law, and culture. So here's the part that most people overlook, okay? It's not just where the money is, it's what the rules let you keep. 2 entrepreneurs can build the exact same business in 2 different places and end up with totally different outcomes. But why? Well, because the rules of wealth are not uniform, my friend. They're shaped by taxes, law, and culture. So first of all, law, protecting what you build. Because wealth dies fast without property rights. If governments can seize assets, if contracts aren't enforced, if corruption runs wild, you're building on sand. That is why investors trust places like Switzerland, Singapore, or the US. The rules are predictable. A contract signed in London will be enforced. A patent registered in Silicon Valley is protected. Now compare that to Russia, where billionaires are known as oligarchs because their fortunes are tied to politics. One wrong move and your wealth flies out the window. Now here's probably something you didn't know. The World Bank ranks economies on ease of enforcing contracts. So it takes 120 days on average in Singapore. In India, over 1,400 days. That is 4 years of legal limbo before you can get paid. Second of all, we have to look at taxes, okay? What you get to keep. Because it's not really about what you earn, okay? It is what you can keep, and taxes vary wildly from place to place. In Monaco, personal income tax is 0%. In Dubai, corporate tax is minimal. In France, top income tax rates can exceed 45%. In Scandinavia, taxes are high, but so are the social benefits. So, it's the same million earned, but a completely different take-home. And that's why wealthy people are hyper-mobile. They're moving for math. The billionaire migration trend is proof of this, okay? In 2023, China lost over 10,000 millionaires to outbound migration, while Australia and Singapore gained thousands of them. Even inside one country, rules change the game, okay? California has a 13% state tax. Texas has 0%. That gap has triggered a mass migration of founders, investors, and companies from Silicon Valley to Austin, Texas. Then there's culture, okay? The invisible rule book. This one is a bit less obvious, but it's just as important. Culture decides how people treat risk, failure, and ambition. In the US, bankruptcy can be a badge of honor. Investors often prefer someone who's failed before because it shows experience. In Japan, failure carries a heavy stigma. That cultural pressure makes entrepreneurs more cautious, which slows down risk-heavy innovation. In Germany, precision and reliability dominate. Products are built to last, but the startup failure rate is lower because founders only launch when they're nearly certain. The takeaway here is that culture sets the ceiling on what is normal. Living in Silicon Valley, raising $10 million for a risky idea feels pretty standard. But living in a conservative town, that same ambition might look insane. So, here's a couple more cases where rules shaped the outcome. Consider Ireland. By slashing its corporate tax rate to 12.5%, it attracted Apple, Google, and Facebook. A single policy turned Ireland from Europe's poorhouse into a global tech hub. Or Estonia. By launching e-residency, they let anyone in the world open up an EU company online. Suddenly, a basic Baltic nation became a magnet for digital entrepreneurs. Or Switzerland. Its centuries-old banking secrecy laws made it the vault of the world's wealth. Even after those laws softened, the brand stuck and money kept flowing in. So, the takeaway here? Laws protect what you build. Taxes decide what you keep, and culture shapes whether you dare to start at all. Strong laws and smart taxes are multipliers. Weak laws and predatory taxes are wealth destroyers. And culture either fuels ambition or it suffocates it. The rich already play globally. They live in one country, bank in another, incorporate in a third, and sell to the world. It's called geo-arbitrage, and that is the final layer of this wealth map we're looking at today. Because the rich, well, they're already mixing and matching the best parts of the world. That is what geo-arbitrage essentially is all about. You live where the quality of life is high. You incorporate where the taxes are low. You hire where talent is cheap, and you sell where customers are rich. That strategy can 10x your odds of success, okay? And there are 3 ways to do this. First of all, live cheap and earn high. This is the digital nomad model. Earn in strong currencies, spend in weaker ones. A dollar goes 5 times further in Thailand than it does in Los Angeles. That gap is pure financial leverage. And if this is the kind of working lifestyle you'd love to carve out for yourself, we've actually got an expert-led collection within the Alux app dedicated to guiding you to becoming a successful digital nomad. Scan this QR code to get a discount. All right, second of all, you gotta be book smart. Even early stage companies now choose Delaware, Singapore, or Estonia for incorporation because of certainty, investor credentialing, and more favorable tax and regulatory climates. And third, you've got to play globally, okay? Manufacture in China, design in Eastern Europe, and sell in the US. Just look at pretty much any Amazon seller. That is geo-arbitrage at scale. Corporations do it too, okay? Apple issues bonds in the US at low interest rates while booking profits in Ireland at low tax rates. Nike manufactures shoes in Vietnam, markets them in Los Angeles, and reports profits wherever the math works best. Private equity funds often operate out of the Cayman Islands, raise money in New York, and invest globally. Geo-arbitrage is not slowing down. In fact, the future of wealth is borderless. In India, in the last year alone, India added nearly 50 million new internet users. That is more than the entire population of Spain coming online. The country now has over 880 million active internet users, and its tech and fintech sectors are scaling faster than almost anywhere else. In Africa, well, the continent is leapfrogging old systems entirely. Mobile payments are turning basic phones into full-on banks. And by the end of 2025, Africa will have over 500 million e-commerce users. That's 500 million consumers skipping credit cards and going straight to digital wallets. In Southeast Asia, a new middle class of hundreds of millions is emerging. Indonesia, Vietnam, and the Philippines are leading the charge with rising incomes and smartphone adoption, creating some of the fastest-growing consumer markets in the world. Global retailers are already rushing in to capture this wave. In Latin America, Brazil's online sales are growing at nearly 20% year over year, and Mexico is seeing a surge in digital banking adoption as well. Backed by young, urban populations, Latin America is shaping up as one of the next great battlegrounds for e-commerce and fintech. So here's the big picture. By 2030, a disproportionate share of new millionaires is likely to emerge from rising economies. For most of history, your location was destiny. Born in the right country with the right markets and rules, and your odds of becoming wealthy skyrocketed. Born in the wrong one, and the climb was almost impossible. But we are slowly moving toward that borderless economy we mentioned. Technology, capital flows, and digital platforms are making it easier than ever to build from anywhere, sell to everywhere, and structure your business in the smartest places. It doesn't erase the importance of location, okay? Cities, tax systems, and ecosystems still tilt the odds. But it does mean you've got more control than ever over where and how you play this game. So put this together with what we've already covered, okay? The industries that make wealth easier, the tests that every millionaire has to pass, the archetypes of the people who do it, and now the places that multiply your odds. This is the full map, okay? In the past, it was reserved for the rich. But today, more and more of it is open to anyone who knows how to use it. We hope you learned something valuable here today, Aluxer, and we'll catch you back here next time. Until then, take care, my friend.